Look, I need you to understand something that's happening right now in the gold market. Something that doesn't happen often. Something that, when it does happen, creates the kind of moves that people talk about for decades. Gold just broke through every major resistance level. And I mean every single one. The technical chart looks like someone took a sledgehammer to a glass ceiling. There's nothing above us now. Just open air. Let me paint you a picture of what this actually means. When a market breaks resistance, it's like a dam breaking. All that pent-up pressure, all those buyers who were waiting on the sidelines, all that institutional money that was sitting in cash waiting for confirmation, it all comes flooding in at once. And right now, gold just broke the dam. The last time we saw a setup like this was in 2019, right before gold went from 1,400 to 2,070 in less than a year. A 48% move. But here's what's different this time. In 2019, we had resistance levels above us. We had technical barriers. We had places where the rally could stall out. This time, there's nothing. We're in uncharted territory, and the technical picture is screaming one thing: vertical launch. Let me show you exactly what I'm seeing. Gold just cleared $2,720. That was the big one. The level that's been capping this market for months. Every time we approached it, sellers showed up. Institutional profit-taking, hedge fund short positions, central bank operations. But something changed in the last few weeks. The selling dried up. And when gold finally tested that level again, it didn't just break through, it exploded through it like it wasn't even there. Now here's where it gets interesting. When you look at the chart, there's no resistance above $2,720 until you get to, well, there isn't any. We've never been here before. This is price discovery mode. And in price discovery mode, markets don't move in nice, orderly fashion. They gap, they surge, they go vertical. Think about what happens when there's no resistance. Every buyer who wants in has to chase the price higher. There's no natural selling pressure because there are no bag holders from previous highs waiting to get out. Everyone who owns gold right now is sitting on profits. And profitable positions don't create selling pressure. They create confidence. But the technical picture is only part of the story. Let me tell you what's happening behind the scenes that's fueling this setup. Central banks are in full accumulation mode. And I'm not talking about the usual suspects. Yes, China's buying. Yes, Russia's buying. But now you've got Poland adding 90 tons in the last quarter. Singapore's monetary authority just disclosed a massive position increase. Even the Swiss National Bank, which has been a gold seller for years, just reversed course. Why? Because they're seeing something in the global financial system that terrifies them. And they're not talking about it publicly, but their actions are screaming it from the rooftops. The dollar's reserve currency status is under assault, not from some fringe movement or conspiracy theory, from the largest economies on the planet. The BRICS nations just announced a gold-backed trade settlement system. Saudi Arabia is letting their petrodollar agreement lapse. France is settling energy contracts in yuan. This isn't theoretical anymore. This is happening right now, right? And when the world's reserve currency is under pressure, there's only one asset that every central bank on earth trusts as the ultimate store of value: gold. Not Bitcoin, not the euro, not SDRs. Gold. Here's what that means for price. When central banks buy gold, they don't buy it like you and I buy stocks. They don't put in market orders and hope for the best. They accumulate slowly, methodically, through private channels and over-the-counter transactions. They build positions over months and years. And they don't sell. Ever. That creates a one-way flow. Supply coming off the market permanently. And that supply has to come from somewhere. It comes from the futures market. It comes from ETF liquidations. It comes from jewelry fabrication getting priced out. But eventually those sources dry up. And when they do, price has to rise to find new sellers. We're approaching that inflection point right now. Look at the COMEX warehouse stocks. They're at multi-year lows. Eligible gold, the gold that's actually available for delivery, is down 40% from last year, and open interest is rising. That's a squeeze setup. When you have rising demand for physical delivery and falling available supply, something has to give. And what gives is price. But here's the part that should really get your attention. The commercial traders, the big banks, the market makers, the guys who usually suppress gold rallies by shorting the futures market, they've flipped. For the first time in years, the commercial short position is at historic lows. These guys aren't fighting this rally. They're joining it. That's huge. Because when the commercials are short, they have an incentive to cap the price. They make money when gold goes down. But when they're not short, when they're actually long or neutral, there's no one left to fight the rally. The path of least resistance is straight up. And the timing couldn't be more perfect. We're heading into a period where every major macro factor is pointing toward higher gold prices. Inflation's not dead. I know the headlines say it's coming down. I know the Fed's talking about victory, but look at the actual data. Core services inflation is still running at 4.5%. Shelter costs are still rising. Insurance premiums are up 20% year over year. The things people actually spend money on are still getting more expensive, and the Fed's about to start cutting rates into that environment. Think about what that means. Lower rates with persistent inflation. That's the perfect storm for gold. Because gold doesn't pay interest, it's always competed with bonds and savings accounts. But when real rates, the interest rate minus inflation, are negative, gold becomes the obvious choice. You're not giving up yield to own it. You're avoiding the guaranteed loss of holding cash. And real rates are about to go deeply negative. The Fed's going to cut. They have to. The economy's slowing. The labor market's cracking. Commercial real estate is imploding. They're going to cut rates back towards zero over the next 18 months. But inflation's going to stay elevated because of structural factors. Deglobalization, energy transition costs, demographic shifts, massive government deficits, negative real rates as far as the eye can see. That's rocket fuel for gold. But there's another factor that nobody's talking about. The derivatives market. There are trillions of dollars in gold derivatives outstanding. Futures contracts, options, swaps, forwards. Most of it is paper gold, claims on gold that will never be settled in physical metal. It's a massive leverage structure built on top of a relatively small physical market. And that structure is starting to crack. We're seeing delivery demands spike. We're seeing basis blowouts between futures and physical. We're seeing premiums for physical gold in Asia hit record levels. The paper market and the physical market are starting to disconnect. And when that happens, when people start demanding physical settlement instead of cash settlement, the whole derivative structure comes under pressure. Imagine you're a bank that's short 100,000 ounces of gold in the futures market. You've been rolling that position for years, making money on the contango, never worrying about delivery because nobody ever takes delivery. But suddenly, people start standing for delivery. You have to go into the physical market and buy actual gold. And there's not enough available at current prices. What do? You pay up? You bid the price higher until sellers appear. And if you're not the only one in that position, if there are dozens of banks and hedge funds all scrambling for physical gold at the same time, you get a short squeeze. A massive, violent vertical move higher. That's the setup we're looking at right now. A technical breakout with no resistance above. Central bank accumulation creating a permanent supply deficit. Commercial traders flipping from short to long. Negative real rates on the horizon. And a derivatives market that's one delivery demand away from a squeeze. Now, I want to take a quick detour here because this is important. If you're sitting on a significant retirement account, I'm talking $100,000 or more in a 401k or IRA, you need to understand how gold IRAs work. I put together a free guide that walks through the whole process. How to get physical gold into your retirement account without triggering taxes or penalties, how the custodian structure works. What the fees look like, it's in the description below. No sales pitch, just information. Because if this gold rally plays out the way I think it will, having some exposure in your retirement account could be the difference between a comfortable retirement and a struggling one. All right, back to the analysis. Let's talk about what happens next. Because understanding the setup is one thing. Understanding how it plays out is another. When gold breaks into price discovery mode, when there's no resistance above, it tends to move in stages. First, you get the initial breakout. That's what we're seeing now. Price clears the old high, maybe consolidates for a few days, then starts grinding higher. This phase can last weeks or even months. It's not dramatic. It's just steady, relentless buying. Then you get the acceleration phase. This is where things get interesting. Momentum traders pile in. Retail investors who've been watching from the sidelines start buying. Financial media starts covering it. CNBC brings on the gold bulls. Bloomberg runs headlines about new all-time highs. And that media coverage creates a feedback loop. More coverage leads to more buying, which leads to higher prices, which leads to more coverage. During the acceleration phase, you can see moves of 5%, 10%, even 15% in a matter of weeks. The chart goes parabolic. Every dip gets bought immediately. Pullbacks last hours instead of days. It's the kind of move that makes people who missed it sick to their stomach. And then, eventually, you get the blow off top. The final surge where price goes completely vertical. where gold rises $100, $200, $300 in a single month, where everyone and their grandmother is talking about it, where taxi drivers are giving gold stock tips. That's the end of the move. That's when you know it's time to take profits. But here's the thing. We're not even in the acceleration phase yet. We're still in the early breakout stage, which means if this plays out like previous gold bull markets, we could have months or even years of upside ahead of us. Look at the 1970s. Gold broke out of its $35 peg in 1971. It spent the next 2 years grinding higher, going from $35 to $120. Steady, boring, relentless. Then, in 1973, it accelerated. It went from $120 to $180 in 6 months. Then it consolidated for a couple years, building energy. And then, in 1979 and 1980, it went absolutely parabolic, from $250 to $850 in 18 months, a 240% move in the final blow-off. Or look at the 2000s bull market. Gold broke out above $300 in 2002. It spent the next 6 years grinding higher, going from $300 to $1,000. Steady, persistent, with plenty of pullbacks along the way. Then, in 2008, it accelerated. It went from $700 to $1,900 in 3 years. And the final move from $1,500 to $1,900 happened in just 6 months. The pattern is always the same. Breakout, grind, acceleration, blow-off, and we're still in the breakout phase. Now, I know what you're thinking. But what about the Fed? What if they don't cut rates? What if they keep them high to fight inflation? Here's the reality. The Fed doesn't have a choice. The U.S. government is running $2 trillion deficits. The national debt is $36 trillion and growing. The interest expense on that debt is now over $1 trillion a year. That's more than we spend on defense, more than we spend on Medicare. It's the fastest growing line item in the federal budget. And here's the kicker. That $1 trillion interest expense is based on an average interest rate of about 3% on the debt. But as old bonds mature and new bonds are issued at current rates of 4.5% to 5%, that interest expense is going to explode. We're looking at $1.5 trillion, maybe $2 trillion in annual interest payments within a few years. The government can't afford that. The math doesn't work. So the Fed's going to cut rates. They're going to cut them aggressively. They're going to do whatever it takes to bring down the government's borrowing costs. And if that means letting inflation run hot, so be it. They'll call it flexible average inflation targeting or some other euphemism. But the bottom line is, they're going to prioritize debt sustainability over price stability. And when the market figures that out, when investors realize the Fed's going to keep rates low even as inflation stays elevated, that's when gold really takes off. Because at that point, it becomes obvious that the dollar's purchasing power is going to erode. It becomes obvious that cash is trash. And everyone rushes into hard assets. Gold, real estate, commodities, anything that can't be printed. But gold's the most liquid, the most portable, the most universally accepted. So it gets the biggest flows. There's another angle here that's worth considering. The geopolitical situation. We're in the most dangerous geopolitical environment since the Cold War. You've got the Russia-Ukraine conflict grinding on with no end in sight. You've got tensions between the U.S. and China at all-time highs. You've got the Middle East on the brink of a wider war. You've got North Korea firing missiles. You've got cyber attacks becoming routine. And in that environment, gold is the ultimate safe haven. It's the asset you want to own when the world's falling apart, because it has no counterparty risk. It doesn't depend on any government's promise. It doesn't require a functioning financial system. It just is. And the more unstable the world gets, the more valuable that property becomes. Think about what happened in 2022 when Russia invaded Ukraine. Gold spiked to $2,070 in a matter of weeks. Not because of inflation, not because of Fed policy, but because investors were terrified of what might happen next. They wanted safety. They wanted something that would hold value no matter what. Now imagine a scenario where tensions escalate further, where we get a real conflict between major powers, where trade routes get disrupted, where financial sanctions start flying, where the global payment system starts fragmenting. In that scenario, gold doesn't just go to $3,000 or $4,000. It goes to $5,000, $6,000, maybe higher, because it becomes the only universally trusted form of money, the only asset that works in every jurisdiction, under every regime, in every crisis. And we're moving toward that scenario, not away from it. The world's becoming more multipolar, more fragmented, more unstable, and that's incredibly bullish for gold. But let's bring this back to the technical picture, because ultimately, that's what's going to drive the next move. Gold sitting right above $2,720, the breakout level, and it's holding. We're not seeing any significant pullback. We're not seeing profit taking. We're seeing consolidation, tight, sideways, price action. And that's exactly what you want to see after a breakout, because tight consolidation after a breakout means the buyers are still in control. It means there's no urgency to sell. It means the next move is likely to be higher. And when you look at the volume profile, it confirms that. We're seeing declining volume on any small dips and surging volume on any move higher. That's classic accumulation. Smart money is using any weakness to add to positions. The moving averages are all aligned bullishly. The 50-day is above the 200-day. The 20-day is above the 50-day. Price is above all of them. That's a golden cross setup. And historically, when gold forms a golden cross and breaks to new highs, the average subsequent move is 30% to 40% over the next 12 months. If that plays out, we're looking at 3,500 to 3,800 gold within a year. And that's the conservative scenario. The momentum indicators are showing strength, but not extreme overbought conditions. The RSI is at 65. That's strong, but it's not at the 80-plus levels you see at tops. There's room to run. The MACD is positive and rising. The stochastic is in bullish territory. Everything's pointing up. And the sentiment picture is interesting. We're not seeing euphoria yet. We're not seeing retail investors piling in. The gold ETFs are seeing modest inflows, but nothing crazy. The mining stocks are up, but they're not parabolic. There's still skepticism, still people calling for a top, still analysts saying gold's overvalued. That's perfect, because bull markets don't end when there's skepticism. They end when there's universal bullishness, when everyone's convinced it's going higher, when there's no one left to buy. We're nowhere near that point. In fact, if you look at positioning data, hedge funds are still relatively underweight gold. Managed money positions in the futures market are well below the levels we saw at previous peaks. There's still a lot of dry powder on the sidelines, a lot of potential buyers who haven't pulled the trigger yet. And when they do, when the momentum becomes undeniable, when the breakout is confirmed beyond any doubt, that's when you get the real move. That's when gold goes from 2,700 to 3,000 to 3,500 in a matter of months. Let me give you a specific scenario for how this could play out. Over the next few weeks, gold consolidates between $2,700 and $2,800. Boring sideways action. Some people get frustrated and sell. Some people take profits. But the dips keep getting bought. The support holds. Then, sometime in the next month or two, we get a catalyst. Maybe it's a Fed rate cut. Maybe it's a geopolitical event. Maybe it's a major central bank announcing a huge gold purchase. Whatever it is, it's the spark that ignites the next leg. Gold breaks above $2,800, then $2,900, then $3,000. And at $3,000, the financial media goes crazy. Gold hits $3,000 for the first time ever. The headlines scream. Retail investors start piling in. Your neighbor asks you about gold stocks. Your financial advisor calls to suggest adding some exposure. That's the acceleration phase. And during that phase, gold could easily run to $3,500 or $4,000. Because once the momentum gets going, once the narrative shifts from gold's overvalued to gold's going to the moon, the buying becomes self-reinforcing. And here's the beautiful part. Even if you miss the initial move from $2,700 to $3,000, you can still make money. Because the acceleration phase is where the big gains happen. That's where gold goes from $3,000 to $4,000 in 6 months. That's where the mining stocks double or triple. But you have to be positioned before the acceleration starts. Because once it starts, it moves too fast to chase. You end up buying at the top, right before the inevitable pullback. So the question is, what do you do right now? If you don't own any gold, this is the time to start building a position. Not all at once. Not with money you need next month. But systematically, over the next few weeks, accumulating on any dips. If you already own gold, this is the time to hold. Don't get shaken out by short-term volatility. Don't sell just because it's up 20% or 30% from where you bought it. This move is just getting started. And if you're looking for leverage, the mining stocks are where you want to be. Because when gold moves 50%, the miners can move 150% or 200%. They're leveraged plays on the gold price. But you have to be selective. You want the high-quality producers with low costs and strong balance sheets, not the speculative juniors that might not survive a downturn. The setup is clear. Gold just broke through every major resistance level. There's nothing above us now. The technicals are screaming higher. The fundamentals are aligned. The macro environment is perfect. And the smart money is accumulating. This is the kind of opportunity that comes along once or twice a decade. The kind where you look back 5 years from now and say, I remember when gold was at $2,700. I should have bought more. Don't be that person. Don't let this opportunity pass you by. Because when gold goes vertical, and it's going to go vertical, the gains are going to be life-changing for the people who positioned themselves early. And the regret is going to be crushing for the people who sat on the sidelines. The breakout is confirmed. The path is clear. And the launch sequence has already started. The only question is, are you on board?